Welcome to the Hills, Modern Money, the next chapter in banking, regulation, and financial trust. Please take your seats. The program will begin in about 2 minutes. Welcome to the Hills, Modern Money, the next chapter in banking, regulation, and financial trust. Please welcome Bill Salmon, SVP of Editorial Content at The Hill.
Thank you. Thank you. Good morning and welcome. My name is Bill Salmon. I do work at The Hill. I'm so delighted that you joined us here on this ridiculously cold morning. I probably should have taken an Uber here. I want to start with a question. What do banks, fintech, and emerging digital asset firms all have in common? Well, they probably have several things in common, but the thing I'm thinking of is that they are all working to build systems that are faster, that are more accessible, and that are more interconnected. The thing is, when you make changes like that to an industry, you end up unleashing a bunch of challenges and risks that you might not have foreseen. A lot of those are going to end up being addressed by policymakers. In other words, you end up raising a number of very important questions. And I hope today in our program we get to a number of them, especially these three. How can innovation and oversight advance together, imagine that, to reinforce trust in the financial system? What does responsible modernization even look like? As traditional and digital financial services continue to converge? And finally, how will a more technology-forward landscape impact the future of consumer protection, market competitiveness, and overall financial stability? Fortunately, we've lined up some really smart people to answer these and other questions today. I'm talking about lawmakers from both parties, financial experts, industry leaders. They will help us understand how to use technology and policy and risk management together to build a financial future that is secure, that is competitive, that is resilient. So we hope everybody follows along the conversation today on social media. We're using the hashtag #TheHillEconomy. I'll repeat that, hashtag #TheHillEconomy. I also want to take a moment to thank our sponsor, the Bank Policy Institute, for their generous support in making today's program possible. Now, today's program is going to start with a really interesting panel on the topic of how do we best defend ourselves against the scams and the frauds that come with today's modern money age. So I want to introduce some very special people starting with my colleague Sylvan Lane, who is the business editor of The Hill, and he's going to be moderating today's event. But we also have not one, but two congressmen from House Financial Services, starting with Pennsylvania Republican Dan Muser, who is chairman of the Subcommittee on Oversight and Investigation, so you might want to stay on his good side. And then we have Illinois Democrat Bill Foster, who's ranking member of the Subcommittee on Financial Institutions. So again, thank you so much for coming, and please let's give a warm welcome to Sylvan and our two congressmen.
Thank you again for everybody who came out this morning and for everybody watching at home. I'm looking forward to our panels today, but first and foremost, Congressman, thank you so much for joining us. So we're going to start off with a conversation about fraud and scam protection, which is something that I know both of you two care a lot about and spend a lot of your time in the House working on. So, to kick it off with a general question, and I want to hear both of your perspectives on this, but we could start with you, Congressman Foster. How have the nature of scams and fraud related to banks and financial services changed over the past 2 years as the technology that people use to manage their money, hold their money, grow their money have changed as well?
Yeah, well, it's moved online, I guess, is the one sentence answer to that. The tool at hand really to prevent identity fraud, which is really at the heart of all scams, these digital driver's licenses, mobile ID, that are being rolled out. The standards are actually for that were all set back in the about 10 years ago at NIST. They've been adopted by the International Standards Organization, and now the EU, the UK, countries all around the world are adopting the ISO standards that are effectively the NIST standards and as digital driver's licenses. And that's why Android and iOS actually interoperate, because they've all adopted those standards. Because there's sort of two problems in identity theft, which is the core of the matter. If it's an easy thing if someone shows up in person. When you show up at TSA has a pretty easy job. They have to say, okay, are you presenting a real valid passport or ID or real ID? And is that your picture on it? It's a much more complicated thing if someone comes in with an internet claiming they are Bill Foster, because then sort of the best you can do is to say, okay, first off, this person is presenting the digital version of a passport or a real ID compliant driver's license. And so they're a legally traceable person. Then, and it is being presented on the cell phone that is associated with that digital ID. And thirdly, that cell phone is telling me that it has just completed or recently completed the biometric login, that someone has smiled at the cell phone and confirmed that, at least to the best of the cell phone's ability, it is in the possession of its rightful owner. And so those three things, when combined, are sort of the best you can do for proving you are who you say you are online. And if we get that incorporated in our modern economy, basically as soon as possible, that's the best first line of defense against this.
There's probably too much trust in the system, right? In IT in general. We've done banking over the years, and pay your bills when you get a notice, get something in the mail, you pay the bill, you might check, but you don't, because it comes in consistently. But what we're not prepared for is the type of cleverness of the fraudsters and the scammers. Because I think everybody in the room has probably either been attempted to be scammed, or someone very close to you, or your son, your daughter, your mom, your grandfather. And so it's just wildly prevalent. And yet at the same time, the companies that are involved in facilitating it, that's the wrong word, in enabling it unintentionally, banks, social media, telecoms, are doing a lot. We had a roundtable the other day. I mean, the level of resources that they're pouring into to try to defeat this, to mitigate it, to find it out, prevent, and then inform law enforcement is significant. But it keeps getting worse. So they have to do more. There are things social media accounts for almost something like 50% of the fraud and scams that take place, they enable it via websites. Check fraud is prevalent. Telecom, I mean, you're getting texts from EasyPass. Hey, pay your EasyPass. It's you owe $8.99. Put in your credit card right now, or you're going to lose your license within 24 hours. And some of these are coming from international criminal organizations, very, very involved, sophisticated organizations, and some of them are just occurring domestically. So it's a little bit of a challenge to catch them because they move, right? I mean, where it's not like a bank robber and you chase them down the street and catch them. So I think everybody's stepping up. We're definitely stepping up. The education of consumers in general. Some banks are doing it great. Some banks aren't doing it so well as far as informing and educating their customer base what to do, what not to do, what not to fall for. Social media, the same thing. I'll acknowledge that Google, for instance, seems far and away done more to prevent scams and shall we say. Their block rate is a lot higher for allowing scams than some of the other social medias. But I think we're kind of waking up to it more than before. But again, what they've already done is impressive. And I think you may be aware the DOJ just started a strike force that should be pretty meaningful as well.
So when it comes to the things that the federal government can do, let's start with the enforcement side on the strike force side. Do you feel like the federal government has enough information and enough visibility into how these scam networks are operating based on the fact that, as you said, they're constantly moving, they can target people through text messages, emails. Do you think there's enough of a federal eye into what's going on here?
No. We could, but we haven't uncovered it all and utilized all of the law enforcement resources of FinCEN, for instance, on the international basis, for illicit finance, the FBI, the DOJ, the Secret Service, Treasury. We need to uncover it better and respond to it faster.
Congressman Foster, what do you think on the long
Look at all of this stuff, all the scams you talked about stop the moment when someone attempts to send me a text message. You say, okay, prove you are who you say you are. People can send me an email or a text message, but if they're unwilling to present digital proof that they are a legally traceable person from a country that I can extradite them from, they can send it to me and I'll put it in my spam filter, because that is almost certainly what it is. I mean, how many of you even read the contents of your spam filter? Okay, and it's and that's because we're already completely dependent on the best AI, Google's AI, if you use Gmail, that tries its best to identify these things, but they morph on a minute-by-minute basis. And for high-value transactions, you simply can't trust the identity unless there's a positive proof. And again, the tool at hand for that are trusted electronics in your cell phone associated with a national ID. A real ID, a passport, something similar to that. Other countries get this, and the UK, after decades of resisting it, has acknowledged recently that they have to do it too to join the EU. It's amazing how that just enables a flowering ecosystem of financial products. If you look at the incredible thing that's happened in India. In India, there are more than 1 billion people that have digital ID and bank accounts. And if you want to give a beggar 3 rupees, you both get out your cell phone, smile at your cell phone, authenticate, and authenticate your bank account and transfer 3 rupees from your account to his, 0 fees. Okay, and this is as inclusive a system as you can imagine. And it's working for billions of people. But what they do not have is that system being abused for ransomware. Because if they have the ability to go, if a fraud has been perpetrated, you can go to a judge or trusted criminal justice system and figure out who it was behind that ransomware. So it is not completely anonymous, all right? And that is a crucial part of it, that there is a trusted government. Now you can argue about whether the Indians have that right on the level of trust in their government, but we've navigated that in the case of the normal banking system. In the U.S., under most circumstances, bank-to-bank transfers are pretty anonymous. But if the government shows there's a real suspicion and there's a real investigation from a system we trust, they can figure out where your bank transfers are going and who's on the other end of them. And that's crucial. And in Scandinavian countries, for example, every time a government official looks at your data, you get a little message on your citizenship app that some bureaucrat has looked at your data, all right? Which is a pretty solid way of knowing that your privacy is not being abused and your government can be trusted. So I think there's a lot to learn from where the rest of the world is going on here, both from the point of view of getting a financial system that's much more efficient and has a higher level of trust in it, and from the sort of very strong privacy requirements that I think people are going to demand.
Congressman Muser, what do you think about the idea of employing something like that in the United States?
Sounds like it works, and it will be helpful. I mean, let's face it. You call, they ask you your mother's maiden name, things like that, right? I mean, that's sort of rudimentary compared to what could be done and is being done successfully elsewhere. So it's probably not just necessary, but critical. To have such a
huge example of that was the COVID identity fraud. The U.S. taxpayer lost between $200 and $300 billion during COVID. A lot of it going to North Korean and Chinese hackers, with people claiming unemployment insurance benefits and things like that, and COVID benefits. And that did not happen in countries that had a secure digital ID. They said, hey, your app said, hey, you're eligible for some sort of COVID benefit check. Log in, smile at your phone, authenticate to your bank account, and boop, your COVID benefit check went there and nowhere else. And that stopped the North Korean hackers cold, because if they can steal 1 million passwords, but unless they also steal 1 million cell phones and can do the biometric login on those stolen cell phones, they're out of business. And it's, this is, it's something our office has been working on for, most of a decade now, ever since the great work at NIST. There's a big push by this administration, which I agree with, which having U.S. standards adopted for artificial intelligence. There's a huge advantage. And the next frontier here is agentic AI. Because the standards for my agents talking to your agents are being written as we are. It's basically chaos. There are multiple competing standards. And I think one very useful government role should be to convene everyone, probably at NIST again, to come up with standards for what it means to have my agent talk to your agent. So that the very first thing they'll do is they'll come down and do the equivalent of scrolling down and hit I accept. That will understand when they start talking to each other. What are the privacy understandings? What are the data retention understandings? What are the if it goes off the rails legally? Do we go into arbitration? Do we go into a legal system of Lithuania or where? And all of that stuff can and should happen under the hood for the agentic communication that I think everyone agrees is going to be the next step in financial services.
So when it comes to so the idea of the just jumping back a little bit to the national ID, do you encounter any potential obstacles in trying to convince people that this will help their privacy and security if it would require them to register certain biometric information, raise the specter that there might be another venue through which somebody could access information they don't want? That balance between access and security, how do you think you could strike that, both technologically and in terms of the political argument you make when you're trying to get skeptics on board with this?
Well, yeah, okay, yeah, thank you. This is, look, traditionally, anytime you present something that sort of smells like a national ID card, you get the ACLU jumping down your throat from the left, and you get sort of these Red Dawn people, if you know what I mean. I'm jumping down your throat from the right, the libertarian right. But the vast majority of people in the middle just want a system that is reasonably secure and reasonably private and very trustworthy. And so that's the first thing. And what's changed, I think, is that people are sick and tired of spending the afternoon on hold changing all of their credit cards and magazine subscriptions because someone's stolen their numbers. all right? And the biometrics, which are a crucial thing, first off, the NIST standards very cleverly said, okay, only store your biometric login information in your cell phone. Now, for example, even the thumbprint reader on some cell phones, the data for the whorls and the shape of your thumbprint never leaves the chip underneath the reader. Only an encrypted summary gets transferred to the CPU in your cell phone. So even if you're eavesdropping on the communication between the thumbprint reader chip and the CPU, you have no idea what the cell phone is, what the thumbprint is. It is just so it's a very well thought out system that sort of maximizes privacy. Then there is a need at some point to store biometrics somewhere from the point of view of preventing what's called civil fraud, where you have one person sets up multiple identities. And the thing that people have come to trust for that is to have the biometrics there held by the individual states. You know, everyone who has a driver's license or a state ID understands that their state is holding a picture of them, a high-resolution picture of them that that can be trusted and can be used to figure out if you're getting a driver's license in Illinois when you already are operating one in New Jersey and New York. And so, and that is the compromise we've come to. I guess it's because for some reason everyone really trusts the cybersecurity of North Dakota, but that's the way it is. And so it's something that you don't have to change anything. We already have for the Real ID system in the United States, something that pretty much accomplishes the purpose of a national ID card without actually having a national ID card. Same thing happens in other countries. In Germany, for example, all of their different federal states, they hold the biometrics, and because I guess no one trusts the Bavarians or whatever it is. And so that individual states hold the biometrics, and then they get together to make sure you're not operating IDs in multiple states. And so it's a solved problem. It's a little bit clunky, but it does work, and it allows you to have the benefits of a universal, unique identifier. They don't advertise it a lot, but the Real ID is actually associated with a social security number, and so that it's from a computer. I'm sort of a computer guy, and you can't really build a database without a database key, and that's your social security number or a bunch of proxies that we have for it, and it's really essential that you have a unique identifier.
See, having a PhD in physics from Harvard is very useful in Congress.
Exactly. Congressman Musimer, what's your perspective on those issues?
That sounds like a leap forward, and these things are important. It probably doesn't need to be compelled, right? It could be something, if you want to have this level of safety and allow our society to get used to it. Some businesses may be the ones to pursue it, and that's what we're trying to do right now with our fraud and scam work that we're engaged in. We're holding meetings, and I described some of it, but our first roundtable was the private sector, as I was mentioning. Various from telecoms to banks, of course. J.P. Morgan, Meta, you name it, we had a great group. Our next roundtable, and you're very welcome, is public DOJ, FBI, FCC, that group as to what they can bring to what we must bring to the table and work on. So we really don't want a government-led initiative. Right? It needs to be holistic from a society basis and government basis. And don't get me wrong, though, this isn't something that's new. I mean, scams have been going on for a while, and many great organizations have and the government has put resources to combat it. It's just getting worse. And even with the resources going towards it. So there's a big education initiative. Like, I don't know if I mentioned, I'm even running public service announcements throughout my district and many other members. Our chairman, French Hill, is doing it now throughout Arkansas on what to look for, what not to do, et cetera. We're, putting together, we had a hearing on it. And we had people that come in from the Aspen Group, for instance. I just, tend to quote what they had to say. It's just unbelievable, the level of international criminality and the amount of scams that take place, as well as how harmful it is. I mean, this isn't data. This isn't, a bill. I mean, people are really suffering because of this. I mean, there's a high suicide rate. When someone gets scammed for $30,000, they're just so upset with themselves. They can't believe that they did that. If I travel, they're doing different on news. The news is doing different, segments on this person was scammed. Watch out for that scam. So it's really just becoming that much more, I don't know about mainstream, but affecting that many more people. So we've got that, and then we need to educate. Again, I mentioned earlier, some banks are reducing their scams. It's not increasing. So a lot of that is through informing and what to do, what not to do. Secondly, we need to bring in. We need to have, where it's being enabled, recognize that their block rates, 95% block rate of a scammer, is not very good. In fact, it's terrible. It should be close to like 1 in a million, as opposed to the number of sites or requests that they get. And with AI and everything else, and who knows, maybe we are going to need some legislation that says if you don't maintain a certain block rate, or even if you don't, the number of reports that come in, and if you get 1,100 reports of scams on a particular website, that site should be halted for 30 days and be put under review. Now, they'll tell you all they'll do is head to another site, but okay. But at least we know who they are, and we can track them down. And that's why I was really happy to see the strike force take place over at the DOJ that I understand Janine Pirro is heading up along with others. So we will meet with them. And then there's the enforcement, right? We've got to catch some of these people and make examples of them, so it's clear that there's going to be significant penalties surrounding this. Google, for instance, just had uncovered a huge scam network, fraud network called Lighthouse out of Burma. And what these wonderful people were doing was they were literally bringing in, making slaves of people, human trafficking, and having them, hundreds, if not thousands of individuals engaged in creating scam initiatives on primarily the United States and Europe. And Google had a lot to do with uncovering that. So there's progress being made. Things can be done now, but certainly what Bill's talking about really should be the next step, the next level.
And on the business-facing side of that too, it's one thing to have an ID to say, this is Sylvan Lee, this is, who he is. But let's say I get a text, like you were saying, from EasyPass saying, or allegedly EasyPass saying, my license is going to be suspended if I don't pay, $200 right now. Is there something either the government or society can employ on the business side that shows that person, yes, this is EasyPass, this is Pepco, this is whatever utility or agency that you actually need to be interfacing with? Or is it a matter of procedure in that, you don't just, necessarily give your information out over the phone or one way or another like that? Is there, something on the business side that you think should or can be enforced that way?
I think they're pulling together more collaboration and creating, like our suggestion was, an association of anti-fraud, so they could share best initiatives, best models. But they need to do it, and frankly, if they don't, our job is oversight, investigations, and to protect the general welfare. If they don't, I would suggest that requirements and legislation would follow.
Yeah, and I think the essential government role here is to provide, the registry of businesses that are for real, and how they digitally identify themselves. And same thing for people. So that when your grandma gets a text message from some romance scam, the very first thing that happens is whatever app she displays the text message on should filter that and say, that's interesting. This text message says they're from in New Jersey, and in fact they're from Mexico or wherever. They're not who they say they are, and that should just be built in to all these things. That only works if there is somewhere a registry of unique people who are legally registered and ultimately extraditable, and if there's a similar registry for businesses. If you're getting contacted by a business, there has to be a legally traceable path to find out who that is, and if they're not who they say they are, to go and punish them or at least blacklist them. Once you've done that, if you have basically what they call in banking the KYC, know your customer system, automated, then that's a huge cost savings for everyone in financial services, whether it's small community banks or giant banks or fintech startups. One of their biggest costs is doing the KYC process. It was costing, during COVID, it was costing something like $400 a person to have someone open a bank account who'd never had one done before, and never bank account before. And once you've done that, once in your life, you go into the Department of Motor Vehicles and you get your picture taken with a high-res picture and prove you are who you say you are, get your cell phone registered with that real ID. You do that once, and then you can use that again and again when you open a new bank account. It should take 30 seconds, where basically the bank says, okay, get out your cell phone, present your digital ID with the biometric login, using the biometrics in your cell phone, and then they will check with FinCEN, the federal government, that agency that has a list of bad actors, and if you're not on that list of bad actors, boom, open the account. And providing some sort of legal safe harbor for businesses that are willing to transact that way. And it's optional. If people want to go and live off the grid like the Unabomber and do everything with paper, they're welcome to. But then understand it's going to take you a few days to open a bank account while we do the paper trail check to find out if the paper documents that you presented are real, and it's just not going to move as fast.
Congressman Muser, we're just about out of time. So given that you're used to doing these PSAs in your district, what do you think is one thing that the folks watching at home should know or keep in mind about how to either spot or protect or prevent being the victim of a scam like the ones we were talking about today?
Pause, review, hang up, call an official phone number. If something is on text, call again, easy pass, that sort of thing. Hang up and look at the official phone numbers and exactly how to get a hold of that directly, not having them call you call them. Just be on guard. I hate to say caveat emptor, but that's usually said in a more positive way. Here we really need to be diligent. We want to, in government, we want to alert folks to it, but as well deal with it and do everything we can to compel our businesses to put those resources towards it. When I was in business, I won't get into the product, but we'd have believe it or not, we'd have a recall on occasion, right? And when you have a recall, you gotta leap to. You're not instructed. You get in trouble if you don't, if it's that bad. But you gotta jump to it. You've got to take care of your customers. You gotta take this on yourself, and it's good business in the end. But it's also the right thing to do. So here we have these instances taking place with. I'll just go back to social media for a second, because a lot of it comes from there. They need to stop it. They need to engage in it. They need to have a recall of that, where that part of their business is causing harm to the general public. And, they must, and they need to do it better. And if they don't, we'll do our thing. We'll be dragging them into hearings, and we'll go public on it, and we'll establish legislation that who knows, they might not like. but we're not going to allow this to continue to get worse, or we're going to do our very best to keep it from happening.
Well, Congressman Muser, Congressman Foster, I'm looking forward to seeing the progress you two and your colleagues in Congress and the administration are able to make on that front. Thank you two so much for joining us today, and I really appreciate you taking the time.
Thank you.
Thank you.
Our next panel will focus on consumer data and open banking. Please welcome Natalie Talpas, EVP and Head of Retail, Digital, and Emerging Payments Strategy at PNC, Kate Prohaska, Managing Director and Head of Consumer Regulatory Affairs at JP Morgan Chase & Company, Adam Russ, Director of Financial Services at Consumer Federation of America, and Angelina Bradfield, Head of Policy at Financial Technology Association.
Good. Thanks so much.
Hello. Okay, right? I'm happy to.
Okay, so for our next panel, we, as mentioned, are going to dive into the issue of consumer data and open banking. I think a good kind of way to kick this off is just, what exactly the nature of open banking is, what that means, because, you think open banking, someone might think, okay, what time is the bank open, or is my app actually working? But, Natalie, can you just tell us a little bit about what exactly open banking is and how most people in their day-to-day lives are kind of interfacing with it?
Sure, yeah. It's such a big question to open up with, but you got to level set. So many of you might be familiar with the concept of sharing your bank data with financial applications that you have downloaded on your mobile device. For years, though, we've also been doing that with other personal financial management tools. One of the first ones is Intuit's Mint. We remember Mint. Being able to securely share your bank account transaction information in a way that allows you to use it elsewhere with some other ideally trusted entity. Previously, prior to open banking entering and creating a more safe and secure method of customers doing that, there were methodologies that data aggregators would use called screen scraping. And screen scraping, for those of you that don't know, is just what it sounds like. And unfortunately, it also includes, most of the time, collection of bank credentials, so your user ID and password that the customer would use to log in at their bank. Again, prior to open banking, that information was collected, held, and then used to log in and literally screen scrape all of the data that was accessible to the customer through their online banking portal or mobile app. And there's certainly risk in that. There is lack of transparency, and it's often, being stored and saved and used and accessed outside of when the customer expects it to be used. More data is being captured than is expected, and is being stored and used by unregulated entities most of the time, right? Through data aggregators or the fintech customers that they work with, or other types of entities. And so what is open banking? Open banking enters the room and starts to enable usage of secure banking APIs that include the data that is expected or needed for customers to use the financial apps that they wish. And so it also includes a methodology where the customer is redirected to their bank site. So at PNC, when a customer is interested in sharing their data with an app or other experience that they want to use, they're able to request that, identify, hey, I'm a PNC customer. They're redirected to PNC to securely log in with us. Representative Foster talked about this in the last panel, actually, making sure that there's device information, there's information available to the bank to ensure, okay, yes, this is Sylvan, right, who's logging in and is requesting to share their data. So once that process takes place, we're also able to display at PNC, we're able to display and say, Sylvan would like to share, you'd like to share your data with perhaps Venmo, for example. And Venmo is requesting access to this account information. They'll also need your account number because they intend to move money. So we're able to display information that is understandable to the consumer. They understand for how long this information will be shared and how they can control it. And then, the other thing that we do, and some banks do, I look forward to more banks doing, is if you do want to permission your account number, we are tokenizing that. So we're creating a unique tokenized account number that's unique for Sylvan and Venmo, and this is my little example here, that should you choose to no longer use Venmo, you can come in and let PNC know, hey, I no longer need to share money or share data, or you no longer want Venmo to be able to move money from your account. We would be able to kill that token and ensure that if Venmo were to have a breach or share it elsewhere, or it's somehow otherwise intercepted, your account would be secure, and we wouldn't need to recreate that for you. So again, this concept is an environment where ideally consumers should be able to securely permission, share their data with ideally trusted entities that their bank is fully aware of and can ensure that they're doing so in a transparent, safe, and secure way.
Now, with that as a starting point, Angeline, I wanted to throw to you because I know a lot of the businesses and groups that are part of the members of your organization have a pretty important role in the open banking ecosystem. So I wanted to, get your perspective on how you and your member organizations are navigating all that. Especially as there have been a lot of regulatory changes and proposals in this space, which I do want to get into later in the panel as well. But just to kind of kick it off, what kind of things do you see as, your members are navigating the seas of open banking, if you will?
Absolutely. And thanks so much for having us today. So, I think that first I would want to emphasize right now, over 100 million Americans are leveraging open banking to do a lot of what we just heard, right? Connect to their budgeting apps, fund their cryptocurrency wallets, split the check at dinner. There are multiple uses, and I think first, maybe I should explain who FTA is, maybe for a second here. I represent the Financial Technology Association. We're a trade association that represents fintechs, I think, in no surprise. Within that construct, we have both sort of the data aggregators that are providing kind of the consumer permission data sharing tubes, but also some of the third parties as well, like the Venmos and others of the world. And so I think, from that perspective, we see the value to open banking, not only, from kind of the ability to keep this innovative financial infrastructure flowing, but also to the consumer itself, to be able to kind of leverage their financial data in a way that makes sense for them, and to have more of a holistic view of where their finances are at. So, for example, in that budgeting piece, their financial institution may not be able to provide them with some sort of a budgeting app, and they can go and permission this data to a third party to be able to allow that. I think, outside of that, I think there's a lot of things that you'll hear today where we agree, and areas, of course, where we don't. I think we are very focused also on ensuring the privacy and protection of this information and making sure that, the existing privacy frameworks apply and that there are strong consumer protections around it. I think some of the things in the final 1033 rule that we supported included the prohibition on screen scraping, except for sort of the smallest of banks, allowing for, or the prohibition on cross-selling, other types of sort of security elements. So, from that perspective, we strongly support an open banking framework, and we want to see sort of the way in which it's been constructed upheld going forward.
Sure. And Kate, I wanted to ask your perspective on, how at JP Morgan you've been able to kind of navigate all that as well. And I guess the areas where you think there are agreement and some areas where, there might be some conflicts that need to be worked out over the regulatory process or just the process of businesses working with each other to kind of figure out what works best for everybody.
Yes, absolutely. And thank you so much for having us today. It will be no surprise JP Morgan is on this panel. We've had a little bit of news on data aggregation over the last 6 months. But I think a couple things that are kind of lost in a little bit of the noise is JP Morgan has really been at the forefront of data aggregation. We rolled out secure APIs almost a decade ago. And so we have been investing in the infrastructure, and we want our customers to be able to operate on their apps, we want to ensure that we're getting away from the unsafe practice of screen scraping, as Natalie was mentioning.
And I think, the growth in the ecosystem really has been paved from the investment that we and other banks like PNC have been able to make it more secure and more safe. Want to throw out a couple of numbers there. So it's been kind of hockey stick growth over the last couple of years. Right now, JP Morgan gets pinged 2 billion times a month to our APIs, and that's up just from 1 billion 2 years ago. We serve 11,000 apps, and that's up from 5,000 2 years ago. So I think given the evolution of the ecosystem and that, there was, through our negotiations, it does seem like folks were pinging our system more than necessary. There is going to be a little bit of shift in the dialogue and discussions. And another fact that I want to throw out there is that the 2 billion is actually more than the UK on a monthly basis. So I think that oftentimes people will look at other systems, that have had kind of a more top-down regulatory approach. But the US, as we sit here today, does not have a regulatory structure when it comes to data aggregation. And we are thriving more than kind of any other country in the world, I would say. So we've been able to, for market-driven solutions, create bilateral contracts with the data aggregators, and then they create contracts with the fintechs, obviously. And that has been able to govern liability, third-party risk management, data access, all through our secure APIs. And, we're hopeful that the CFPB won't take a kind of heavy-handed approach and ensure that those free market solutions continue to develop so this ecosystem continues to thrive.
So when it comes to, the broader ecosystem, the news that you referred to, the agreement that JP Morgan recently reached with certain companies in order to secure some fees for accessing that data. What is the purpose of those fees in terms of how it relates to JP Morgan's business? Is it maintaining the infrastructure? Is it a matter of fairness? Can you talk to me a little bit about, what that kind of comes into for your businesses?
Absolutely. I think that is a great question. If you think about it, there's really no business model that bases their inputs for free forever. In our bilateral contracts, we've been able to charge since the beginning. And I think given kind of the hockey stick growth that I mentioned, that is a huge tax on our systems. And as Natalie was mentioning, there's a lot of data flowing out there. And what really is the most important to us is that our customers' data is secure and protected, and that we need to ensure that they aren't taking data that's unnecessary. And so I think given, I have so many analogies for this, but I will try not to bore this group. But any type of business, let's say, one that I use is often a chef making omelets and he gets eggs for free. If it goes bad or a couple break, you're not as judicious about making sure that you're controlling over your inputs as much if you actually have to pay for it. That's just basic economics. So I think what we've learned through our discussions is some people have told us, you're right. We could pull 30 to 50% less data. And that is pretty illuminating. And some of the end fintechs that we've talked to was wow, I had no clue that was being pulled as much as it was. So the reason we're charging per call as opposed to a monthly basis is to ensure data is actually being used the right way. And then Natalie also mentioned TANs, the tokenized account numbers. So some PFM apps, the personal financial management, that doesn't have anything to do with payment initiation was also just, again, it's free. Let's just take all the payment the TANs. And so once we announced our intention to start actually charging, people are more judicious and thoughtful about it. And a ton have been deregistered because they don't want that information flowing out there. And so I think through, again, private sector negotiations, we've learned a lot from the discussions as well, or making technological improvements. But as, once people actually have to pay for things, start thinking about, well, do I need to ping this often? Or, I think our two-legged customers look at their app 7 times a month. Sometimes we were being pinged 10 times a day or more. And so, I mean, it's just not simply the same thing as a two-legged customer. And so I think it will improve, similar to like when APIs were introduced. I keep calling this kind of the third iteration. Like that was kind of like then open banking 2.0. And then now it's like, okay, we're maturing even more, going to be more judicious about the data we're actually taking. And this can be like a more safe, secure ecosystem like open banking 3.0.
I think, could I add to that as well?
Sure, but after I want to get Angelina's perspective on this too, because I want to know how your members are dealing with these fees, or if there's any sort of difference.
And sorry, real fast, I do have to say, because I don't know if it's been out there that much, like we have signed, I know that a lot of people looked at some of the larger agreements, but we have 100% of our API traffic from data aggregators, like that includes fees. And so like the market is working, and so just have to throw that out there, sorry.
No, that's fine. I was just going to mention, I think, the other element here in play, and there's, I forgot to mention it earlier, like an industry group, Financial Data Exchange. I sit on the board of it, other banks, Chase, everybody's
yep.
And as well as fintechs and data aggregators. And it's a collaborative environment where we're all talking about this, right? And first and foremost, that entity maintains the technology specification that's used to organize the information in the API so that there's interoperability, et cetera. But it also, there's grounded principles that we all agree to around data minimization, safety and soundness, ensuring transparency and control for the consumer. And the data minimization principle that Kate was just talking about is not being recognized or observed in the practices that we see today, because all of the raw materials, the customer's data, the TANs, is free. And so I think, again, just reiterate the opportunity for the market to continue to settle itself and recognize that there's value exchange and investment being made, and a need to ensure that there's an opportunity for fees across the board.
So Angelina, these fees, do they have a negative impact on your members? Are they something that you've been able to kind of factor into the cost of business? How is this economic model kind of changing for you and your members?
Sure. So, I think it's really important, and you can check our court filings to follow this up. From our perspective, the statute doesn't allow for fees. It says that, in Section 1033, that consumers are able to access their and provide their information to third parties upon request. It doesn't say with a fee. And I think, from that perspective, Congress, when they want to attach fees to something, does so. That did so in Dodd-Frank. It does so in multiple bills and laws. And so I think from that perspective, we feel very strongly that this ecosystem has evolved without fees, and it has only been recently when some of these competitive elements started to arise. And I think perhaps one of the key elements to that conversation is that, according to sort of public reports on term sheets that were provided, there were different fees leveraged for different uses. I think that is one of the impactful pieces of this discussion. I think the second piece, I would say, we've spent a lot of time talking about data pools, so I do want to talk a little bit about that as well. From an API perspective, there are a lot of different ways that APIs can be created. So, many times a consumer can connect multiple apps from their bank through an API, and that's going to require additional calls. At the end of the day, as we've all sort of said, this is consumer permission data that a consumer is permissioning to be able to be pulled. And so we absolutely support principles of data minimization, but there are many ways, even through the infrastructure of the APIs, that can cause additional pools. So that's part one. I think the second piece is we need to recognize consumer expectations here when we're talking about data pools. For example, I used a budgeting app for many years, and I think going through that process of, allowing for that information to be imported in, I will acknowledge that I probably checked it about 10 times a day because I wanted to see where it was coming in and be able to categorize my transactions appropriately. But I think one of the, latency, when I opened that app, I wanted to have that information there. I didn't want to wait for it to load to be able to then go in and categorize it appropriately. And so consumers expect to be able to access that information immediately. They don't expect to necessarily, not have access to it when they open the account or their app. And I think that's really important as we talk about this conversation, because I think the consumer perspective and what they expect to be able to use their data for and how they want to use it is an important component.
And Adam, speaking of, the needs and expectations of consumers at the Consumer Federation, I wanted to ask you how you're kind of seeing the way that all of this is shaping up and the concerns that the Consumer Federation of America might have about any direction that the 1033 rulemaking may be going, or the business practices may be going.
Thanks. So I think this rule, while it didn't get a lot of attention within my community of advocates, I think it is actually one of the more significant things that the CFPB accomplished. We're really talking about privacy. We're talking about how consumers can control a very valuable asset that exists about them, which is their data. How can they permission it? How can they revoke the use of it? I would even say, to the point that Representative Muser made earlier and that Kate's reiterated about the number of data pulls, I mean, it would be very revealing and impactful if consumers even knew how frequently their data was being pulled. Can you imagine an obligation for a fintech to have to alert the consumer that they just pulled their data, or if the bank was literally keeping a ledger of all the pulls? I think immediately people would wake up and say, wow, things are happening in this economy that I'm not aware of. So from our perspective, certainly privacy is a key element of why it's worth weighing in on this process. I also think this is a case of something that's moving so rapidly, right? We know where open banking is now, and certainly open banking is prevalent, and consumers want to share their data, and they are. We're at a point in time, though, where it seems like we've decided to freeze regulation. Someone raised the point earlier, who is going to enforce 1033 if it happens? And of course, there are many reasons to be concerned that it will immediately be relitigated in courts, especially if there's a fee that comes out of the reconsideration rule. So, there's a lot to worry about there. I'm worrying about things like ChatGPT. We know that people are now at the point where they are frequently uploading their data into generative AI systems for use cases like financial services. We can expect agentic AI for payments to really transform the velocity of how people shop and the integration with tender, with payments, and that'll include integration with stablecoin. I think we're sort of at the precipice of more, and this rulemaking was for consumers an absolute win, and where I'm very, very fearful, and I think there's plenty of reason to believe that the next round won't necessarily be a win for consumers. I thought the rule was successful, and by its own measure, the fact that various industry segments weren't happy, everyone got something, but no one got everything, is a testament to reasoned rulemaking, which I know this audience with the prior administration, there's frequently a debate about whether or not that happened very often, but in this case, it seems like perhaps that was the case. So lots of reasons to be optimistic about the need for consumers to have more control over sharing their data, and lots of reasons to be worried about where the market is moving forward.
And Kate, now I wanted to ask you how you're kind of seeing the way things have shaped up with the 1033 reconsideration. Obviously, there's a big change in administration, a big change in priorities in between when that rule came out in 2024 and the current administration in 2025. I'm sure everybody has read a little bit about that. But in terms of the massive shift in the way that the government has approached these issues and regulation, and quite frankly, the CFPB itself, what are you anticipating out of this rule, and what are you looking to make sure, stays from 2024, and what you're looking to see differently?
I'm happy to jump in. Sure, happy to, yes. So as Angelina mentioned, looking at the court filings, reasonable legal minds will disagree, of course. And so I think that we would advocate, as the banking industry and BPI sued on the previous rule, is that Congress knows how to give fees out and fee caps. I mean, if we look at the Durbin Amendment, they were very clear in Dodd-Frank about Reg II and kind of what costs are included, what are not included, looking at safe harbors with late fees and different things like that. If anyone in this room is as nerdy as we all are, please read the statute. It'll take you 5 minutes. It's like half a page and has absolutely nothing to do with fees. And so I would say that both that and what is being litigated right now is definition of consumer. Our position would be that this is consumer access to information, which is what it's actually called, as opposed to, so that's two-legged consumer or potentially their fiduciary, not kind of, anyone they click a terms and condition to that they don't read and they don't know that they have a relationship with. And again, to be super nerdy, I'm going to read you a quote from Barney Frank. He recently said that when we passed Dodd-Frank, the aim was to build trust between consumers and financial institutions. The intent was not to create a new class of middlemen who undercut the work of institutions and warehouse consumer data. And so, I mean, there isn't a lot of legislative intent here, but I think that that was pretty remarkable statement from, a named author of Dodd-Frank. So we are looking for, a rule that complies with the statute. It is a very narrow, tailored statute. It was 2010 when it was passed. That is 15 years ago, which is insane. But I mean, this whole data ecosystem, agentic AI, as was mentioned, none of that was contemplated. And this was really about sharing consumer data, institutions not blocking it. I mean, right now, everyone can go on their online banking app, and we are, for all intents and purposes, complying with the language of 1033 by being able to download your data, do all of that. But I don't think it was contemplated to have, data aggregators, 11,000 apps. So, I mean, it was just a completely different world in 2010 when it was passed. So what we're hoping this administration will actually kind of put out a rule that comports more in lines with the text. And I think that we are hopeful of that. I mean, obviously, Director Vogt and, the leadership team over at the CFPB seem to be more statutory constructionalist. And, that kind of makes more sense and bodes well for both a reasoned rulemaking, but also litigation path going forward. There was a preliminary injunction earlier this year, and the judge did say, BPI by and large would prevail in the likelihood of success on the merits, given, kind of the overreach, and maybe not being in line with the statute previously. So we're hoping it's more narrowly tailored and will let the market flourish.
I think, just to add, I would agree with what was just shared there. And I think, the other piece that that our comment letter includes and that we've talked publicly about for some time is what I started with, screen scraping. I think Angelina even said, right, there's support across the board to ban screen scraping and ensure that consumers are protected from that practice. And I think, there's an opportunity as the CFPB is looking to simplify the rule. And I think we're all going to get this Christmas present here soon, right? To see if they get it. Yeah. That they do consider, a more strong element related to ending screen scraping and requiring that. And at a minimum, ensuring that there's consumer protections associated with it. So.
And with the previous rule, I mean, as Adam was mentioning, we supported a ton of it. I was on his conferences panel last week and, agreed with a lot of what the consumer groups were saying. Data minimization, prohibition on screen scraping, prohibition on secondary data uses. So, I mean, I think that but again, all of that wasn't in line with the text of the statute. And so we'll just kind of see where they come out. But we're definitely, we need to just ensure that anything that evolves in this ecosystem, there is trust from our customers, because I think that is what's going to, what we're concerned about is that oftentimes our customers won't know that they have a relationship with a company or whatnot, so they're constantly coming to us. And so we have to handle and deal the claims and all of that, and it degrades the trust in the entire system. And so we want to ensure that that is supported.
So I just wanted to jump in. First, I don't really think the CFPB is paying a lot of attention to Congress. It's a mixed bag at best. But going back to that point about consumer agency and downloading data, I think it's unrealistic to reasonably interpret what is needed with a data sharing regime to say that it only encompasses downloading XLS files. I can say as someone who used to be a photojournalist that I, until age 32, did not know what Microsoft Excel was, didn't know how to use it. I don't think many Americans know how to use it. I don't think we want a world where everyone's financial information is sitting on their hard drive. That seems really risky and unuseful. We also, I don't think, want a world where to use a a fintech app, you have to establish a fiduciary relationship. That seems unusually burdensome and crippling to the whole ecosystem of data sharing.
And I guess I wasn't advocating for that. I was just saying theoretically that could be the statute. But I mean, we want our customers, I mean, like I said, you know, we are pro open banking, innovation, and that's why we've invested so heavily in this space. I was just playing the, you know, reg lawyer.
Oh, that's good. And I want to say that while FTA was not on our panel, MX was, and Chi-Chi was in my seat. So that was a lively conversation just like this one.
Yeah.
And speaking of lively conversations, I want you all to just, you know, jump in as you see fit. You four are very much in the mix in a way that I am not as a journalist, so I want to hear your perspective. So Angelina, I see you. I want to know what you have to say
indicating
about
a response. You know,
See the floor.
Yeah, thank you. You know, I think probably this goes to the point Kate made, which is legal minds may disagree, and I think you know, different sort of circuit court jurisdictions also disagree as well. We see that play out a lot right now, and I think, you know, from that perspective, I would want to emphasize open banking has been happening for decades. So I think it's fair to say that, you know, from when Dodd-Frank was constructed, open banking was already happening. So the idea that, you know, you would have to have this fiduciary relationship, that you couldn't necessarily share this information with a broad set of representatives is not one that we would agree with at all. And I think, you know, the second piece I would say too is, you know, when we're talking about fees and we're talking about market dynamics, there's something to be said for the fact that one, and this was actually said at Adam's conference last week, fees ultimately do trickle down to the consumer. So I think that's something we need to keep in mind as we have this conversation. The second piece I would add is that ultimately, if we really go to a world that doesn't necessarily have a 1033 reg at all, and it's just based on like bilateral agreements, which my understanding is there's maybe 20 to 25 with maybe each financial institution, then they took, you know, almost a decade in some cases to put together and to sort of get the data flowing. That's one, going to restrict obviously consumer use and access to their financial data potentially in a broader sense. And I think the second piece is the market dynamics change as the entity gets smaller. And I think that's something, when we think about the market infrastructure here and the incentives that different actors have in this environment, it is important to have a strong sort of permissioned framework for the industry at large and to encourage kind of innovation and the right rules of the road going forward.
You know, to your point, the point that several have made about the fact that it's been 15 years since Dodd-Frank was passed. In those 15 years, the financial system, the way people interact with each other financially have changed dramatically. You know, it makes me wonder, does Congress need to come in and, you know, maybe rewrite that section, write new things, maybe update it in certain ways? I know the idea of trying to rewrite Dodd-Frank in the waning months of the session right before midterm elections start may not be that practical, but, you know, is there maybe a legislative gap here that could help resolve some of these questions that are currently getting hashed out through the regulatory process and in courts?
I would, I don't think so. I mean, I think that, like I said, I mean, right now there is no rule and we have the most robust open banking system in the world. And so I guess, and to Angelina's point, like, I definitely agree that we want to have consumer permissioned access and data flowing. The question is, and where we would disagree is, do they have a statutory right to the data? And I think that therein lies the difference. Like, even if we, as, you know, BPI or JP Morgan or whatever, may not believe that they have a statutory right, we're still permitting that to happen. And so I think that, like, in the absence of the rule, it's been incredibly effective. And so I'm like, what problem are we trying to solve here in a way? And so I think that, you know, we will see a rule come out, and I think that the market will just continue to evolve. But I don't know if we would need congressional action necessarily.
Yeah, I mean, I've on our business team, I probably should have said that from the start. I'm not a policy person, but I think, as I think about it, the opportunities are more about, again, many larger banks have had their APIs established. We use a company called Akoya that helps us maintain a one-to-many relationship. We don't have to maintain the 15 to 20 direct bilaterals, and I think it's also an enabler for the smaller banks that have a need to do this and create that same control and transparency for their customers. But I think the opportunity is just, let's create a level playing field, right? Like, I think there's market forces in play that have not been equal, really, right? Like, banks have traditionally, when we think about open banking, everybody thinks about the data providers as the banks. And, increasingly over the last several years, technology companies, other entities have started to get involved in consumer payments and have information that is also being stored for consumers. And some of them are taking steps to create a portal where a customer can permission their data, but some are actively blocking it. And so when we think about opportunities as this, moving forward, I think there's opportunities associated with ensuring that everyone is acting right? I don't know how else to say it. Like, stop screen scraping. Everybody recognize that consumers want to be able to share their data. Stop taking more data than you need, right? Like, it's just fundamental data privacy practices. And I think if we can all be aligned on that and use the guidance from our regulators and to proceed, like, that's the path that we need to continue to be on.
And I think that there was one point we haven't mentioned is that there was in the previous rule, there was a prohibition on banks charging, but then the data aggregators were allowed to charge the end fintech apps. And that is what's currently happening today. So we knew the market rates because we are actually paying data aggregators currently for aggregation services that we import. So it seems like a total market distortion to have a prohibition on one party in the ecosystem, but then the other parties are allowed to charge. And so, I mean, it really comes down to, like Natalie's point, to me, it's maturity in the ecosystem and everyone having skin in the game. So if there's a data breach or, you need to ensure that you have investments in the systems. And I think that is kind of where the market is headed already.
So it would be good if Congress would weigh in on fees. Another thing Congress might want to consider is Graham Leach Bliley. Is it a realistic and effective way of permissioning data? It's not useful at all. It doesn't work at all. So I'm worried about that. Loper Bright hangs out there. The possibility that the courts will actually decide, and which court decides is its own kind of random question. So I'm worried about that. And then you made the great point about the portal. And that's one of the things I really hope isn't lost in the rule. Not all institutions are offering portals right now. My institution has a portal, but it's difficult to find it. That's real. That's a real issue. I think it would be great if that kind of portal capability existed. It would be so useful for people to actually see where their data is going and how frequently and for what purposes it's being tapped.
So, sorry to be so chatty, but Adam, question. If Congress were to intervene on fees, would it be just on banks charging or also data aggregators charging the fintechs?
It's an interesting question, and it's interesting how you'd construct it. I mean, I know with Durbin, there were thoughts about the least cost being, the least cost provider or the average cost provider being the right way to think about how to construct the fee. And I think that would probably be the same case here. You'd maybe want to think about the fee being based on the least cost. I hesitate to make an answer on that question beyond that. I think that would be I know Kate Berry's here. So.
You're not trying to make news today?
No, please go ahead.
I was going to say, if I can I'll also respond. I think, so let me emphasize a few things. I think, one, the innovations that we see in open banking today were made with the promise of a 1033 rule. And I think that, it's important to emphasize that the change in fees when these APIs were built, there was investment also on the fintech side to build the APIs, to build, to work with the banks to create these systems. I think, both sides have already put skin in the game here. I think there's a separate technology question about the provision of providing the pipes for the third parties to receive the information that we can talk about. From a statutory perspective, it is our view that the statute has made it very clear that the consumer has the right to provision this data and provide it to the representatives of their choice, and then two, that it's upon request, not with a fee.
So, thinking about how this all is going to shape up, obviously there's been a lot of areas of agreement in terms of, consumer control of their data and everything like that. But I also wanted to get to, the broader question of, is there a question of, certain data that should or shouldn't be transmitted, or how much data is useful to these apps in general? And, if there's a way of kind of streamlining it so there might be fewer pings on the banks and less of a concern for the apps in terms of fees that are being charged. Is there any sort of consideration to that, whether in the rulemaking process or just in the ways that you've been thinking about this at all?
I think that again, Kate's mentioned that we've talked about it, right? In the U.S., the market-driven movement in its ecosystem to date has sort of done that, right? So the Financial Data Exchange, the FDX, the technology specification includes a process and environment where any entity interested in participating in this ecosystem can come, participate, learn, discuss, participate in working groups, and therefore all perspectives are considered when creating the spec. So the tech spec lays out what data elements are available to be shared. So, and I think, the kind of baseline, at least as we've looked at it, is a customer should be able to permission the data that's available to them today in their online banking portal, right? There's some entities that had suggested, like social security number and other more sensitive information that's just not necessary to be shared by, or even, permission from your bank be considered. So I think, in terms of the data is available, I think the spec has done a nice job, I think, of recognizing that there's all sorts of different types of data that a customer might want to share and that could be available. And I think it's created an environment to allow that to continue to grow as changes evolve and things happen. Does that answer?
Yeah, no. Adam, did you want to weigh in on the specific kind of data that should or shouldn't be available?
I just think data minimization in general is going to make the system safer. It's going to make it less vulnerable to problems. So that's important. Data revocation, we haven't mentioned that, but again, that's a really useful tool. In terms of additional data points, to be honest, I haven't thought about that. Maybe I'm not a fintech, so I don't want to say anything about that.
Sure.
I mean, the other thing at play here too is maybe consider secondary use, right? So customers permission their data minimization principles should apply, but also it shouldn't be buried or even not even disclosed at all, that their data may be used for other purposes or accessed more frequently than they would expect. So that's also just an undercurrent kind of theme and topic that I think is important to the discussion as well.
Certainly. And Angelina, if you want to bring us home with that.
Sure. So I think you're actually going to hear a lot of agreement here. I think first, we agree that customers should be able to sort of leverage the information that they see on their banking app home screen to be able to share it. I think maybe the one area, and we support, of course, data minimization and really a level playing field when it comes to the application of the GLBA framework in this environment, which goes to the secondary use discussion. I think. But we also, of course, support modernization on GLBA too. I think the final thing I'd add is, as we think about where the industry is going and what a consumer wants to use their data for, it's going to be about broad financial management. So ensuring that all of the different pieces of the way that you're using your finances, no matter where you are in your life, you can be able to kind of plug in and get a holistic view of what your current sort of financial state is and use that information for, permissioned underwriting to shop for products that may make more sense for you from a financial perspective. I think it's about ultimately the uses for the consumer and where that can go in the future. That's going to be really important to this discussion.
So, and final thing I'll add is that is why, because the data ecosystem and financial services has shifted so much, that any final rule should apply to also fintechs and non-banks. I mean, over 60%, maybe 70% of the mortgage market is originated by non-banks. But previous rules, and conversations, banks would be the only data providers. And so to get a holistic picture of consumers' financial health should also mean that the fintechs and all of that are filtering into the system too.
Certainly. Well, unfortunately, that's where we're going to have to leave it. I would love to talk about this more. I'm sure we will be once that rule drops, and hopefully it's not too close to the start of Christmas or anything else. But thank you all so much for being a part of our panel today.
Thank you.
Thank you.
Thanks.
Our final panel will explore U.S. bank charters as they continue to serve as the primary pathway for responsible innovation while maintaining stability and consumer protection. Yet as the new market participants emerge, regulators are examining whether existing chartering frameworks can keep pace with novel business models and uphold the principles of safety and soundness that underpin the banking system. To discuss, please welcome Paige Padano-Paradon, EVP and co-head of Regulatory Affairs at Bank Policy Institute, sponsor of today's program; Michelle Alt, co-founder and managing director of the Claros Group; Summer Mersinger, CEO of the Blockchain Association; and Brian Lavender, SVP of Digital Assets and Innovation Policy at ICBA, the Independent Community Bankers of America.
All right, so for our final panel today, I wanted to thank you all so much for coming out. So we're going to be diving into bank charters and the nature of them, how they're changing. So Paige, I wanted to start with you. People might think a bank is a bank is a bank, but what exactly does, these differences in charters entail, and what exactly makes a bank from your perspective?
Right, that's a good question. For most of us, for most Americans and consumers, the term bank is sort of used ubiquitously to refer to any type of institution that you can put your deposits in and obtain loans. But the reality is that our banking law has evolved over hundreds of years, literally, and so there are some quirks in the statutory framework. We also, of course, have nationally chartered banks and state chartered banks. And so you also have, state chartered entities. And among the various charters, there are different features and requirements that apply. But under the National Bank Act, the OCC is tasked with chartering national banks, which we believe requires some fundamental things. A couple of district courts have agreed that at a minimum, a national bank that engages in full service banking activities, taking deposits, making loans, etc., has to take deposits, and with that obtain FDIC insurance to protect consumers, as well as the financial system more broadly. And then the OCC also has a more limited authority to charter trust companies, which historically were chartered to engage in fiduciary activities and not to engage in the full service banking activities. And there's limitations on the requirements and regulations that apply to those entities because their activities were more limited and the risks were similarly more constrained because of that. And there are a couple of other sort of models in the federal ecosystem. One key one is the ILC charter. And that actually is an interesting sort of hybrid. It's a state chartered entity that applies and obtains FDIC insurance, but it's exempt from the requirements in the Bank Holding Company Act, which means that it can be owned by a parent that is not limited in the activities in which it engages to financial activities. It's sort of a loophole that remains in the statute, in the Bank Holding Company Act statute, that over time Congress has acted consistently to kind of separate banking from commerce for a variety of economic and other reasons, and over time has amended the Bank Holding Company Act to reflect and reinforce that separation. And so the ILC charter and the fact that ILCs are exempt from bank holding company supervision is sort of one remaining piece that needs to be closed ultimately.
Certainly. Now, obviously, we've talked a lot today about how much has changed in banking and banking and consumer financial law over the past 15 years or so. So I wanted to kind of get to the nature of how banking specifically has changed and the different networks of not only banks, but companies that are looking to get some type of bank charter has kind of evolved too. So Michelle, can you talk a little bit about how much has changed in this space, even over just the past 5 years, in terms of the way that financial services companies are pursuing these different bank charter options and trying to figure out what makes the most sense for them.
You bet. And hi, everybody. So why do we care? Let's start with this because you all look bored. So let me look, guys. So my good friend Jerry Buckley is in the audience. If you don't know him, you should introduce yourselves to him. Jerry is incredibly genteel. I am not. So I'm going to be the anti-Jerry here. Why do we care? This is an absolute bare knuckle brawl about who wins. Who wins banking? Who gets to have the privileges that come with banking? And it's super exciting. Paige just did a lovely job of recapping the basic types of bank charters. The threshold question, as she mentioned, when I'm helping a client sort through the array of options is to be or not to be a bank holding company, right? For many fintechs, for many industrial companies, that's absolute non-starter. That sorts you immediately into just three options, really. The ILC, the Industrial Loan Company Charter, National Trust Bank or State Trust Bank charters, or occasionally, very, very occasionally, SEBA credit card banks. So it's a narrow range, and whatever you pick winds up with some limitations on your activities. The things that have changed in the past 5 years, I would actually date it to the OCC's FinTech Charter. Jerry and I had some fun with that back in the day, around 2016, where the OCC came up with the idea that they could authorize, I know Jerry's like, I just wanted to have coffee. and you keep picking on me. If I see some other friends, I'm going to pick on you too. So the OCC said, we have a great idea. We'll charter fintechs that are not subject to the Bank Holding Company Act that are going to engage in a narrow range of activities. You know who really hated that? BPI and the states, right? And that ultimately went down in flames. You're right. You know, that did not succeed. But it spurred a tremendous amount of interest in the fintech sector, particularly. Like how can we kind of figure out how to enter banking? We've certainly figured out better ways to skin this cat. We can deliver products faster, cheaper, and in a more user-friendly way than a lot of the big banks. How can we get a piece of this pie? And for a long time, the answer was not very easily. Not very easily at all. Remember, bare knuckles. We're all being polite, but this is a fight, right? About who gets to win, who gets into the kingdom, right? There are incredible, incredible privileges that come with a bank charter, right? Low cost deposit funding, in some cases access to a Fed master account, membership in Visa and MasterCard, low cost funding in the form of deposit, insured deposits. This is incredibly valuable, right? And the regulators for a long time were basically in the practice, and I am an OCC alum, and so the regulators really were in the practice of industrial policy without a license. They were picking the winners and the losers. And during the Biden administration, they kept everybody out. You know, so since the great financial crisis, we've seen the number of banks drop dramatically from a height of about 19,000 in this country. Yeah, I know, right? 19,000. One might say, why do we need so many banks? That's another question entirely. Now it's about 4,000, right? And during the Biden administration, there were 0 fintech associated charters granted. That was a long 4 years. I was the patron saint of hopeless causes with Jerry and others during those 4 years. What has changed is the regulators are absolutely open for business. The crypto and fintech lobby is ascendant and absolutely getting the audience at the regulators and in Washington. And BPI and others are fighting back hard. So that's what's going on. So
in fairness, let me just say during the Biden administration, the banks also were attempting to innovate. and were similarly denied. The OCC's recently
that's fair.
posted.
That's
the OCC's recently posted a list of all of the requests that came in under the interpretive letters that the agencies issued, saying to the banking industry, you can engage in, just digital asset activities, but you need to come talk to us first. And you can track all of these requests that sat and basically were ultimately withdrawn because they sat for, a year, 18 months, et cetera.
Yeah, that is totally true. During the Biden era, what characterized the banking regulators was an absolute aversion to risk, just risk. So nothing got chartered because no one chartering a de novo bank can absolutely assure that there is zero risk of failure. Banking is risky. You make loans. If you're a traditional bank, that's risky. You can't, all safe is not sound. And the regulators during the Biden era were really crippled by that. They were handcuffed by an expectation that no one would ever lose money ever.
Do you think that had to do mainly with the moment during which the Biden administration took office, given, the incredible economic hardship of the pandemic? Or was this something deeper in terms of the perspective of how, the attitude toward banks and the financial sector has changed, from administration to administration? Because, over the past 10 years, you had the first Trump administration come in and, as you said, kind of lay out the groundwork for that fintech charter. You had the pandemic hit, massive changes in the economy. Now that we're kind of emerging in this, firmly post-pandemic world, do you think that has changed the appetite for risk, or is this mainly an issue of politics and just political priorities?
I know we all have opinions, and I'll stop being so domineering here soon, Jerry, soon. I'll start being more polite. It was definitely political during the Biden administration, and I'm really not taking a side. I'm just saying what I observed. I can tell you, everybody lean in. I can tell you that during the Biden administration, a very senior regulatory official told me that the agencies would take no action that would result in a phone call from Elizabeth Warren. None. That's a political, influence. At the same time, you were talking about the pandemic. I think a big influence on the regulators' risk aversion was FTX, right? So during those years, fintech and fraud were sort of conflated at the regulatory agencies.
I was at the Fed during the financial crisis, and a lot of the entities that were head of those agencies, the banking agencies, during the Biden administration, were also at the banking regulators during the financial crisis. Let me tell you, it was dark. So yes, I do think maybe there's some political element, but I think you also are dealing with individuals and principals who had been through extremely dark times. And that is part of the reason why there was this deep aversion to risk. And FTX and all of sort of the volatility in the crypto markets did not help instill confidence among those principals. That's my observation, personally.
Summer, I wanted to get your perspective on this too, because you kind of have viewed this from a unique position from being at the CFTC. Now that you're on the outside, how do you see things kind of evolving going forward? And, what do you think the big change in perspective has been, not only in terms of the way that the regulators are handling this, but in terms of how companies that are seeking these bank charters have been able to kind of build and move forward?
Yeah, thanks for the question, and thanks for having me here today. I had seen a shift. It was a pretty stark shift from the Biden administration, which I was a commissioner at the CFTC during that administration, and then for a short bit during Trump administration, and now at the Blockchain Association. But I saw this shift in the regulators where it was this approach of they didn't trust anything that they didn't recognize, anything new, anything different. There was mistrust and an assumption that something was being done illegally. And I saw that in every enforcement case that I read that dealt with crypto. I saw that in the way we treated firms that came in. And I think what you see now is this recognition that evolving markets are a good thing. Encouraging innovation is a good thing. And we want the system to upgrade. And I really do think that's part of what crypto will bring to the financial system, is an upgrade in the movement of money and the way that money's held in access for consumers who normally are, some of these consumers who are outside of the banking system for a number of reasons. So I do think there's definitely a different approach by regulators. They're much more open. They recognize the importance of innovation. And it's, to me, it's a healthier place to start from, because it was really frustrating when we were in the previous administration, when everything looked like it was illegal and nobody could define what was legal. It was just all illegal. So I do think we're in a much better place from this perspective of where the regulators are coming at the innovation now.
Brian, I wanted to bring you into the conversation as well, because I know community banks often have a very unique perspective on some of these larger issues, especially involving these firms that have grown dramatically in size and scope and scale over the past few years. So when you're looking at the ways that the bank charting process has evolved, and I should mention that I believe last week the OCC granted, I think it was five trust charters. Conditional. Yes, conditional trust charters. Thank you.
Oh,
I don't want to.
Through.
I don't want to get ahead of the process. I don't want to, just make it anything that it isn't yet. I don't want to get an angry phone call from either side of it. But Brian, so your perspective on how all of this has kind of evolved. What are the ways that community banks see this potentially kind of affecting their unique position in the banking system?
Oh, no, thank you. Great question. I think our perspective is still the sum is greater than the parts, right? When you think about what banks do, right? We facilitate payments, right? We allow for customers to deposit their money, and then we use those deposits for lending, right? And community banks, they bring together all those capabilities under one roof, but with an expertise no one else can provide, right? Meaning the sum is greater than the parts, right? Community banks really leverage the knowledge that they get from living and working, worshiping alongside the people that they call their customers. They're also their neighbors. That is still a really vital element in the American economy. We have a really tremendous role in providing small business loans and providing agricultural loans, right? 80% of all agricultural loans from the banking industry come from us. 90% of small dollar agricultural loans come from us, right? I think it's 60% of small business loans come from us, right? If we were to take a field trip outside this building, I don't think we would have to walk very long to find a small business that's set up because a community bank gave them a loan when no one else would. That is still so important to the American economy, right? What is most of the American economy powered by? Small businesses, right? It's the mom and pop operations, maybe 1 to 10 employees. Where do they go when they need help? They go to community banks, right? So for us, when we see all these ideas about changes that could lead to really fundamental changes to the banking system, yes, we are concerned, right? I know Michelle brought up the point earlier of, do we need thousands and thousands of banks? Yes, we do. Interesting, like a little bit of like trivia, right? We often get the question of like, what is a community bank? Who are the communities you serve? And you could like try to put us in a box based off of like asset size, in which case, 50 billion would be like upper limit. But most of our members, most community banks, well under 10 billion. We've got many that are under 100 million in assets, right? So very, very tiny, especially compared to Paige's members, right?
Yeah.
But the communities they serve, right, they are as diverse as the American landscape, right? I know one in New York City, he considers his community 6 blocks, okay? We have others that serve counties out in the West that rival the size of the smallest states, right? And then even within those communities, those geographic limitations, right, they specialize, right? We have so many that really specialize in serving soybean farmers. I know of plenty in Ohio, Pennsylvania, Kentucky. that have really been able to cater to the unique banking needs of the Amish, right? That is why we need diversity in the banking system. That is why we need thousands of community banks, because the one area where we specialize the most are counties under 50,000 in population, which, just a little bit of trivia, right? There's 3,244 counties in the US. Approximately 2,000 are under 50,000, right? So most of America is small town, right? That's where we fit in, and that's why we care about this and why we seek to have a voice as policymakers.
And to your point about being the sum of the whole of your parts, community banks are also subject to all of the requisite requirements and obligations because you compose those three key components.
Yes.
So one thing I'll just say, because I grew up in one of those small communities, and my mom actually worked at the community bank for most of my childhood. And I agree that no one can replace that, that presence or offer those lending services. My dad's a farmer. He lives off operational loans. And that's certainly an area of the financial system that I don't see going away. But to your point, there does need to be some diversity. And I think when you look at some of the new entrants coming in, I don't think they're looking to compete where there are kind of this established financial system, especially community banks and the roles they serve. They're looking at a new kind of opportunity to, some of this is unbanked, some of this is upgrading payments. There's just a lot of benefits to the technology that I think it actually adds on to the financial services industry, not necessarily competes with. So I have a huge respect for community banks. And, I think there's a place where we can all kind of work together and make sure that the financial system is as strong as possible and serving as many people as possible.
I think that's really well put. I think I'll just come out against mom and apple pie, just for fun, right? But no, of course that's important. Of course the diversity is important. I think the plain fact is you can't put the genie back in the bottle. Innovation is here. Consumers want it. They expect it. And the regulators have kind of woken up and are figuring out how to slot that into the financial system. And yes, it behooves all of us to figure out how to make sure it's done safely and soundly, but it's here.
Now, when it comes to making sure that innovation is done safely and soundly, I know there's this constant tension between, bringing in these new firms into the broader regulatory system to make sure that they are being supervised the same way, and concern about what happens if, in terms of systemic risk, if there are connections between banks and fintech firms or crypto firms or different ways of interacting with each other that may be hard to spot and hard to see. And, one moment that comes to mind was the concerns about, the Silicon Valley Bank collapse, everything involving what happened with the crypto swoon. And I was wondering how that incident might have kind of shaped the thinking around this and shaped the evolution about that, particularly during the era, as you mentioned, where there's already a lot of risk aversion among regulators.
Well, I'll just say, Silicon Valley was not like a problem with fintech banking. It was a problem, bread and butter liquidity risk management, right? And there are questions that remain about, where the regulators were, when this was a very obvious problem for some time. But I do think, yes, SVB and FTX encouraged a pretty chilly, risk-averse environment during the Biden administration. Yeah.
Well, I think that's another good example of, sort of maybe, but made the regulators very reluctant. But what is concerning is that when you look at kind of the history that the OCC has now published, why why was it stated that they would, consider applications and obligations that could come with engaging in digital asset activity, and then it seems like those ultimately, many of them weren't acted on. And there's also there wasn't a lot of transparency either about kind of how that process works. And I think in general that sometimes is something that we're concerned about, the transparency of the process, and what the regulators' expectations are for innovation, because we are very pro-innovation, as I said. All of these applications for members of our organizations wanting to engage in novel activities, and we don't ultimately know what the concerns were or what the risks were. And so now we are seeing more openness from the regulators. The OCC has issued a couple of interpretive letters. All of the agencies together have rescinded some problematic guidance that said essentially that engaging with public blockchain is patently unsafe and unsound. So, and we have been encouraging the regulators to kind of be even more forward-leaning. And, incrementally, may be appropriate. We've taken that position. We're not saying, open the floodgates and let the banking system engage in, any activity in the digital asset ecosystem. But we are saying that generally technology neutral is an appropriate approach, and that institutions should be able to experiment in innovation and become part of the ecosystem in a broader way, which ultimately will benefit sort of novel activities as well. Because at least our members are highly regulated and highly sophisticated and experienced with managing the risks that come with technology, in particular over time.
Paige, I'm so glad you mentioned that. Like, let's review when people argue that these risks should not be in the banking system. It overlooks the fact that the risks exist whether they're in the banking system or not. These activities are going on, and what's the best way to have regulators' eyes on the risks is to have these activities take place within the highly regulated banking system. So when I talk about why banks should be chartered and how it's fun to think about this like winners and losers, I also believe very strongly that these activities should be in the banking system with regulators' eyes on it.
So to follow up on that, and this is FTX is actually a great example of this. So they were applying for some license at the CFTC, a lot of questions about how they would fit into our regulatory remit. But there was a section of FTX, it was their exchange or their clearinghouse, and we did have oversight over that. So the CFTC was looking into what they were doing every day, making sure they had the reserves, making sure they were segregating customer funds, all of that to say that that was the one part of FTX that didn't go down, that didn't, wasn't part of the problem. In fact, I believe the bankruptcy court actually made money when they sold this particular entity. And so I think what that shows is it is important to have eyes on the risk, and there's regulations and laws out there in place to help mitigate some of these risks. And I would rather see that under the federal umbrella than out, on its own without kind of the federal regulators looking at it from a systemic risk standpoint versus allowing it to be kind of fractured and out within the states or offshore.
Yeah, I mean, let me be clear. I agree, but you just said, systemically. And so kind of from our perspective, the activities still have to be, within the contours of the law and what the kind of either the National Bank Act or the Bank Holding Company Act provide. And so to the extent that entities want to engage in activities beyond what a particular charter provides, that is when, we have concerns that the risks are not going to be appropriately overseen or spotted.
So this is the fight, guys. This is the fight, right? What does the National Bank Trust Charter entail, right? I don't want to put words in your mouth, but I can guess, right?
So where's that gap from your perspective? What does that charter not do that would make you and your members feel better about it doing, knowing that, you know, these protections, this oversight, these regulations, you know, what do you want to see there that would make you feel a bit better about the situation happening?
Well, so first of all, you know, we had concerns that when the applications for these charters were published by the OCC, there's very little information provided about what exactly the entities would engage in. You know, historically and in the statute, the authority of the OCC to charter, you know, trust banks, trust companies, is limited essentially to fiduciary activities, trust activities, which historically have basically meant fiduciary. And then, you know, some activities kind of related thereto or supporting that activity. And so we have a number of concerns, primarily with the fact that we are not entirely sure what these entities intend to engage in. They're certainly not sort of your historic, traditional trust bank, you know, managing the assets of a family trust, or even conducting sort of commercial trust activities. And so that's kind of the number one issue that we flag. More information is needed because of the sort of novel nature of these entities and their proposal to engage in activities that trust companies have not historically engaged in, you know, in the digital asset ecosystem. You know, what we wanted to, and we want to understand kind of how the requirements and regulations that apply to trust companies, which historically are more limited in nature because of, again, sort of the limited nature and the relatively simple, understandable risks of kind of your historic trust activities. You know, those requirements and regulations have worked for, you know, traditional trust companies. But when you add on a lot of the activities in the crypto ecosystem and other activities that in some cases, it's not even just crypto. In some cases are very much appear to be creeping into the business of banking, you know, engaging in payments businesses, taking deposits, then the fact that these limited purpose trust companies are not subject to the same requirements that and regulations and obligations in terms of capital and liquidity and risk management obligations, then that's where we start to have concerns. You know, is this a way to engage in what is creeping closer to full service banking without the appropriate controls in place that a full service bank is actually subject to on a consolidated basis? So a trust company charter is generally, they are not subject to the Bank Holding Company Act, which means they're not subject to the activities restrictions, so the separation between banking and commerce at the bank holding company level, nor is there oversight of the organization as a whole by the Federal Reserve.
No, Brian, yeah, please, no, go ahead.
Yeah, I mean, I would echo a lot of what Paige is saying. I mean, look, if you want to be a bank, right? That's what we said all along, right? And we are concerned that, you know, policymakers, maybe for the sake of innovation, want to allow for boundaries to be pushed, right, without addressing all the risks, right? And that's where the danger lies, right? To, you know, kind of link it back to, you know, your question about Silicon Valley. I think what Silicon Valley showed to community bankers is that, you know, we still need to pay very close attention to the system health, right? Whether we like it or not, we are all joined by connective tissue in the banking industry, right? Big banks, small banks, credit unions, we're all in it together. Right? And we recognize that when something goes wrong with one, it can start to impact us, right? Us as a whole, right? Maybe it's like by, you know, settlement failing to occur, but it can also just come from consumers having their trust shaken, right? Our system relies on that trust. It relies on that faith. And so, you know, we are rightly concerned that, you know, as these new ideas come up, these new entrants, if all the risks are not properly addressed, that's where problems arise, right? I mean, I'm a student of history, right? And I think you could trace all financial crises back to somebody somewhere saying, this time is different. I've got the risk under control. But do you, right? That's what we tried to like raise in some of our comment letters, right? I mean, to the point of like resolution. Mm-hmm. When's the last time the OCC resolved an uninsured national bank?
Like 1930s. Yeah.
It's been, a long time. So now we have an untested procedure, right? And that's our concern, right? If something were to fail, what happens, right? And what does that mean for the rest of us? What does that mean for Main Street, right? We have to care about that.
I think one kind of, piece to this puzzle, at least in my mind, is that we are talking, for the most part, about stable coins and reserves. And those are, it's 100% reserve. This is money held to back these stable coins, which are a payment tool. And so the fact that you were dealing with a very safe asset and having a federal regulator ensure that those reserves are custodied in the appropriate way is really important to the system. And I look at, going to this, back to CFTC, and there's a lot of discussion about, the CFTC overseeing spot markets. One of the issues that we ran into with approving certain contracts that would settle on crypto is we didn't have the custody piece figured out. We didn't have the assurance that whoever was custodying those assets had the appropriate oversight. And that's part of what this OCC charter will provide, is that federal oversight to ensure that the custody is done correctly and that the reserves are safe and sound. And I think it's just a good development for the industry and to mitigate the risk that could be in the system.
The reserves are runnable. Deposits are uninsured and they're runnable. That's what happened at SVB.
Well, what happened at SVB too, to your point about resolution, why the FDIC decided they were going to pay back everyone? And there are several lawyers in the room, and Andy Bear, I'm picking on you now. Hi, Andy from Davis Polk, also more genteel than I am. You know what happened that weekend? The lawyers in this room can talk about this. We got calls, absolute panic calls, like, how do we get in touch with the FDIC to show our claim? We have, and the FDIC just couldn't do it. They did not have the ability to sort through, the sub-ledgers and so on. You know what I'd much rather do is have blockchain recorded assets that are immediately identifiable in the case of an insolvency. I would say also that the OCC's approvals on Friday included 180 days liquidity requirement to ensure a smooth wind down, an orderly wind down if that comes up. So the fight, so we're fighting, right? We're fighting. The fight about authority, right? Paige mentioned deposits. That is one of their key arguments, that they're saying that essentially it appears these trust banks are taking deposits. I would say Congress answered this very plainly in the Genius Act, saying that stable coins are not deposits, right? Full stop. And the OCC was very summary in its response to the commenters, including BPI, on those trust banks in terms of, and I'm not an apologist clearly for the OCC, but I would suggest people read the approvals and read the responses to the comments. The OCC just basically said, we complied with all requirements in terms of what information would be public. We gave notice. Deposits, these are not deposits, as Congress has plainly indicated. So this is the fight. You can disagree, but that's the fight. It's kind of cool, huh? Rarely is banking this exciting.
Speaking of which, because, some might argue that they don't want their bank to be exciting, but
a lot of people do, actually. They, it's the genie back in the bottle, about what is a bank. You have, a bank is different in the 21st century. It can be different, the diversity of business models.
So, kind of going back to with the remaining time that we have, kind of going back to what all that means for, average folks trying to interface with that. The idea of your bank is where you keep your money, maybe you have a debit or credit card through them, but now there's, a different organization that might maintain a stable coin that you use. There might be other ways of interfacing with that. Is the issue of chartering an issue that may affect the way that people interface with the financial system, or is, I guess, the end goal to make it seamless that, people have their money, they know what they're doing with it, they have trust in it, and they don't really need to think too much about what letters are tacked on at the end of the name of the commercial?
You know what? Here's where I think I really agree with Paige in terms of when you're thinking about what each charter permits. What's unique about the U.S., for better or for worse, is who regulates you depends on the type of charter you have. In many other countries, the EU, it's predominantly activities-based. The regulation goes with the activity as opposed to the charter. So we do have these arguments over sort of square peg round hole. Well, this is the charter you're going to seek. It's as close as you can get to the activities you want to do. So I do think we have sort of a unique feature in the U.S. that triggers off of what charter you have. Now, I do think consumers are completely oblivious to that.
That's a concern for sure.
No, I mean, they are. My brother recently, I asked him, where do you bank? And he said, Chime. I'm like, that's not a bank, buddy. But I think a lot of people do think so, right? It is not clear. When I worked at the OCC, I used to tell family members, oh, we regulate national banks. And they were like, you mean the ones all over the country? These are not clear distinctions to the average American.
Well, and that's part of the concern too. The closer, these charters historically, the different charters, other than a full-service banking charter, were designed or intended to be very narrow in scope. The closer some of these, new entrants coming in under a charter that is designed for very narrow activity, the more they kind of creep into the full-service banking ecosystem without the appropriate controls. The consumer confusion is another concern as well.
Well, there is certainly a lot for the regulators to sort out, for all of you to sort out. I'm certainly looking forward to seeing how that evolved, but that unfortunately brings us to the end of our panel today, and that also brings us to the end of today's program. I want to thank all of our speakers this morning, our sponsor, the Bank Policy Institute, and to everybody at home who joined us here in the room and online. If you missed any portion of the event, you can see the full video at thehill.com. Thank you and have a great day.